Yep. For more on all this, let's bring in Bleakley Financial Group Chief Investment Officer Peter Boockvar. He's also a CNBC contributor. Peter, always great to get your take on things. You say the economy and the stock market are tied at the hip. We've had quite a roller coaster ride. Is there anything, I mean, in Chair Powell, it doesn't sound like he's going to do anything to save the market. So what's your take on what was said today and the market reaction?
Well, I think you said it right earlier. He specifically said that you need price stability first in order to lay the foundation for a healthy labor market. And that's what he said as he was raising interest rates a few years ago. That was the reason. So that tells me that while maybe at some point they respond to an unemployment rate that's going to 5 or 6%, if at least right now, inflation is still their main focus. He retires in May 2026. He's known as Mr. Transitory, and he's not going to give that up. But if the markets froze up and there was a big problem, I think they would use the standing repo facility or temporary QE like the Bank of England did. That would be their first sort of use of a tool. But they're not cutting interest rates to save tariff policy that gets us into trouble.
Do you agree with that tack? I mean, I'm just curious because there are some people who say that the Fed should be more proactive, knowing that the tariffs were much bigger than we had expected, seeing the reaction the market's already seen, not just the reaction of the financial markets, but also the sentiment surveys, which Chair Powell acknowledged, the steep declines in sentiment when it comes to businesses as well as households.
I understand that belief. I think the economy is on very weak knees right now. But on the other hand, if they did start to cut and then we completely rolled back all the tariffs, then what? Does he then take back what he just cut? So I think he's really left in a very difficult situation, and he has no choice but to wait to see what the end game is with tariffs, what the actual rates are, particularly with China, and what these deals are like. Because how do you sort of get ahead of that until you know what the playing field looks like?
Peter, last week the bond market, rightly so, scared a lot of people. Did we dodge a bullet, or was that just a tremor?
I think it's a tremor. I think the downward trend in the dollar, treasuries, foreigners that own about $30 trillion of stocks, treasuries, and corporates, they are deciding to find other homes for that money. And if we're going to truly cut the trade deficit, we'll obviously have less capital flows that come back into the U.S. So I think this is just more tremors, as you say, and that I can't rule out another test of 5% at some point in the 10-year yield.
Peter, it's Karen. Thanks for being on. Is there a point that the unemployment numbers, what point would you think that would be that would force him to move even without clarity on the tariff and inflation situation?
I think if we started to see, call it 2 to 3/10 increases in the unemployment rate for a couple of months in a row, he's going to respond. I mean, he doesn't want to see a dramatic slowdown and he's sitting there doing nothing. But he'll do something. But there are a couple of risks here. Let's just say he cuts 3 or 4 times as the market's priced in right now. Well, there's risk that the 10-year yield goes higher, just as it did after he cut 100 basis points. Well, we've already seen some vulnerability in the dollar. Well, what if he cuts and follows through and the dollar index, instead of being at 100, goes to 90 or 85? Well, then oil goes to $100, and you see other types of inflation picking up because of that weakness in the dollar. So there's no free lunch here that the Fed can present to us just by cutting short-term interest rates. There are a lot of other possible negative consequences that can come of that.